Alright, Assalamualaikum and good evening, everyone. Sorry for the delay. So for today, we will continue with topic number 2. Okay. Let's see. Okay, so for topic number 2, we will discuss more on risk and return. Okay, and for this week, this is specifically for single security. Okay, single security, meaning for just one single investment. Okay, so we'll define first what is risk and also return. And in fact, actually, we will discuss return first, then baru risk. And then we will try to evaluate, or we try to value returns and also the risk. Okay. So first of all, what is a return? Okay, so return is a reward for investment. Okay, or the benefits that an investor expects to receive over some period of time. So if you remember during our lecture last week, I've listed 4 types of positive returns, if you still remember. We have capital gain, we have dividend, we have interest, and we also have tax benefits. Okay, so those are 4 positive returns. Okay, but for our calculations, the components we split just into 2, whereby the dividend and interest we combine as a form of income return or income gain from investment. Okay, hence we have here dividend and also interest. Okay, and on top of that, we still have capital gain. Okay, whereby capital gain, if you remember, this is actually the price appreciation. Okay, the price appreciation means the price goes up from the initial cost that you pay, and then the price move up higher, obviously, and that is actually the capital gain. And again, if you recall, the capital gain will be considered as unrealized. Okay, until you decided to sell the investment. So it will be considered as return on paper first, and you will receive the actual values of your returns once you sell your investment, or else it will be still considered under unrealized section. Okay, unrealized section. So let's look at the example or how to differentiate between the income gain and also the capital gain. So let's say you purchase 1,000 shares of stock A for 5 ringgit and 80 cents. So when I said 1,000 shares here, you need to remember in Bursa Malaysia, the transactions will be done in lot basis. Okay, it will be done in lot basis, whereby one lot of stocks or one lot of shares equivalent to 100 units. 100 units. Meaning, I cannot buy, let's say I want to buy 20 units of shares, cannot. I must be per lot basis, at least one lot, which is equivalent to 100 units. So in this case, if this person purchased 1,000 shares, guess 1,000 divided by 100, you know this person purchased 10 lots of stocks. Okay, so it will be in the multiplication of 100 units. Okay, seldom we will allow to invest in what we call as odd lots, units. Okay, this will only happen if the company decided to give out dividend in the form of non-cash dividend. Okay, stock dividend, for example. Then you may have odd lots. All right, but in normal circumstances, the number of shares that you will own is based on this multiplication of 100 units. All right, so that's some information that you need to know in Bursa Malaysia. Okay, the transaction must be in lot basis, right? So again, go back to this question. This person purchased 1,000 shares of stock for 5 ringgit and 80 cents. Okay, so this is considered as the cost, okay, the cost or the purchase price, 580. So when I said the price is 5 ringgit, 5 ringgit and 80 cents per share, so meaning this person needs to pay for 1,000 units, 580 times 1,000. So it's about 5,800 ringgit. Okay, so this person pay 5,800 ringgit for the stocks. Okay, and this person wait for 1 year. For 1 year, right? For the price to grow. And later, he or she sold it for 6 ringgit and 60 cents. Okay, 6 ringgit and 60 cents. So from here, you can see the price appreciate. Price increase from 580 and 1 year later to 6 ringgit and 60 cents. So technically, it's about 80 cents increase. Okay, 80 cents increase. That's one thing. Later, or on top of that, this person received a cash dividend. Okay, remember we have two things. Yeah? We have income, which is dividend, and this is price appreciation. So this person received cash dividend of 30 cents, okay, during the same period. Okay, 30 cents per share. So the question can be asked, how much is your capital gain? Okay, remember when we said capital gain, this is price appreciation. So we look at the price differences. Okay, as I said tadi, the difference will be 80 cents. So 660 minus 580 is 60 cents. 60 cents, 80 cents. Okay, 80 cents difference. And this 80 cents multiplied with 1,000 units that this person have, okay, equivalent to 800 ringgit. Okay, so this is what we call as the capital gain. Okay, and this is considered realized profit because the keyword here, this person sold it. Okay, this person sold it. Therefore, this 800 ringgit will be in the account. Okay, this is realized profit. Let's say if this person haven't sold the stocks yet, then this 800 ringgit will be considered as unrealized, just on paper only. Okay, so that's one thing. Secondly, how much is the current dividend yield? So the cash dividend received throughout the time was 30 cents per share. So again, 30 cents multiplied with 1,000 units. The income gain, okay, this is income gain and dividend, is 300 ringgit. Okay, 300 ringgit. So therefore, what will be the total return for this investor? So 800 plus 300 ringgit income gain, a total of 1,100 ringgit. Okay, will be the total return for this investor. So here, as you can see, the source of return can come from two different sources. Okay, one is the capital gain, which is from the capital appreciation, or the capital appreciation. Secondly, from the income gain. Here, the example is dividend. Okay, this is based on stocks. Okay, some other investment, we can look at perhaps besides dividend, interest as well. Okay, depending on the types of investment. Okay, so this is one measurement. Okay, simple measurement. So this is one off. Okay, or as you can say, if we want to analyze it based on the ringgit values, okay, 800 plus 300 ringgit, and the total is 1,100 ringgit. However, to make it more meaningful, or to make it better understanding for the investors, this 800 or 300 ringgit is somehow relative. We're not sure whether this is huge or small. Okay, 800, 300. If we just based on ringgit values. So therefore, to make it more meaningful or more comparable between investment, we have to make the investment returns in percentage format. Percentage. So therefore, we have one kind of measurement of returns, which is in a form of what we call as holding period. Okay, so later on you will see there are two types of holding period returns. We have HBR and HPY. Okay, holding period returns and holding period yield. Okay, I will show you afterwards how to calculate both lah, HBR and HPY. And this percentage can be annualized. Some investment you may keep it for 1 year. Some may be less or some even more. But again, to make comparison between investment, okay, for better judgment, for better comparison, it is more easier to understand if we annualize it. So the keyword here is annual. Annual means per year. So instead of one investment with 6 months and another with 5 years, how to compare the returns? So the time frame is not the same. So to make it comparing apple to apple, so we have to annualize it. Okay, so meaning the percentage must be per year basis. Okay, per year basis. So measurement of return allow investors to compare the expected returns, which is the ER, with the actual return required to justify the investment. Okay, this is where we'll discuss afterwards. Okay, so this is the first one for today. Okay, the HBR, I said, holding period return. Okay, so the first formula for today is HBR, whereby to calculate the HBR, it is based on the ending value of the investment. Okay, the ending value divide with the beginning value of the investment. Okay, the beginning value of investments. And here you will get it in point formats. Point 1.75, 1.64, 1.25, whatever. Okay, it must be in point format for the HBR. Okay, and to get it in percentage basis, we need to calculate the HPY, the holding period yield, or the rate of returns. Okay, so to get HPY, simply take HBR earlier, minus 1. Then you get the HPY. Let's say we go back and look at this question. Okay, I wrote earlier, the cost of this transaction was 5,800. So this is actually the beginning price. Okay, 580 was the beginning price, and this 5,008 is the beginning values. Okay, and this person sold it for 660. So 660 times 1,000 will be 6,600 ringgit. And this would be our ending value, 6,600 ringgit. So simply by having these two information, 6,006 and 5,800, and if you put it here, so the ending value is the selling price, was based on selling price, okay? So it's 6,600, and our beginning value is 5,800. So this would be, let me grab my calculator. Yeah. So 6,600 and divide by 5,008. So here you can see it's about 1.1379. Okay, it's not percent, it's just a point form. So the HBR is 1.1379. Okay, the returns. And to get the HPY, simply minus 1. Okay, minus 1. So here you get 0.1379, or if you convert it into percentage, it's equivalent to 13.79%. Okay, so for this particular person, if you go back to this question, the actual returns, rate of return, okay, is equivalent to 13.79%. Okay, 13.79%. So that's the holding period yield, the HPY, or simply known as the rate of return. Okay, 13.79 or 13.8%. Okay, so this is more meaningful as compared to the return is 1,100 ringgit, for example, ataupun based on this alone. By the way, this calculation is based on price appreciation, yeah, which is based of this 800 only. Okay, I ignore this one just now. Okay, we will go back to this when we have the extension of this. This is the basic formula. Okay, the basic formula. Right? So it's not applicable for this question in total, but in its entirety. So we just focus on this part, yeah. Capital gain. But we use the ending value 6,600 and the beginning values 5,800. Okay, we ignore this part for now, but later on when we expand this formula, you will see we will incorporate that as well. Okay, but for time being, based on this information, based on the capital gain only, the return is 13.79%. Okay. And yeah, so this is based on this example. And for this example earlier, you've seen that I stated here, this transaction lasts for 1 year. Okay, 1 year. So therefore, since it is 1 year, so we cannot calculate the annual HBR, HPY, meaning the annual HBR and HPY technically will be the same because that transaction is for 1 year. Okay, but for other types of transaction, the time frame might be more than 1 year ataupun might be less than 1 year. All right. So if that's the case, okay, we have to adjust. Okay, we have to adjust. So here you can see we have additional formulas for annual HBR and also HPY. Okay, to find the annualized HBR, okay, kalau earlier tadi we have ending values divided by beginning values. Okay, so this is the extension of it. Okay, so this is the extension, which is HBR. So HBR is what? Is this two to the power of 1 divided by n. Okay, or you can put it like this, ending values divided by beginning values. 1 to the power of 1 divided by n. And n here represented by the number of years. So like I said, if based on the earlier example, n is equivalent to 1. So 1 divided by 1 is 1. Okay, so therefore, if we use 1.1379 to the power of 1, you will get the same values. Okay, this annual HBR will be different if the n is anything than 1. So meaning it can be 2, 3, 4, it can be 0.5, 0.6 even. Then our annual HBR will be different. Okay, later on when the example, I will show you another example. Okay, so this is the first or how to find the annual HBR. And to get the annual HBY, similar like before, we just need to minus 1. Okay, we just minus 1 to get the percentage values. Okay, so the difference between HBR and annual HBR is this part only. The part of the power of 1 divided by n. Okay, kuasa, the power of 1 divided by n. Okay, let's look at the very first example here. Okay, so assume that you invest 2,000 ringgit at the beginning of the year and you received 2,200 ringgit at the end of the year. So this is for 1 year. What are the HBR and HPY for this particular investment? So the formula is ending divided by beginning values. So 2002 divided by 2000. So here you get 1.1. You use your calculator, 2002 divided by 2000 is 1.1. And minus 1, get 0.1 or equivalent to 10% return. Okay, 10% return. Very straightforward. Okay, so again, we cannot calculate annual HBR or HPY. Doesn't mean we cannot calculate. It means that the annual HBR, HPY will be the same as well. No changes. Okay, because this is for 1 year. Okay, beginning and the end of the year. So n equivalent to 1. So therefore, it would be no difference between the HBR or HPY with the annual one. Okay, but for this example number 2, we can look better in terms of the explanation and the application of the annualized amount. So for example, your investment of 2,500 ringgit for stock A worth 2,500 ringgit in 2 years. Okay, so this is first stock A. Okay, initially it was 2005 and increased to 3,500 in 2 years time. So technically you can see the difference is 1,000 ringgit more. Okay, so this is one part. Okay, stock A 2005, this is your beginning values for stock A. This is the ending values for stock A. This is the end, 2 years, okay, for stock A. Secondly, the investment of 1,000 ringgit for stock B, right, worth 1,002 ringgit in 6 months. So again, this is beginning value for stock B. 1,002 would be the ending value for stock B as well. And this would be the end, okay, for stock B. So what are the annual HBRs and HBYs of these two stocks? Okay, these two stocks. So based on the formula of annual HBR, which is we have the power of 1 divided by n. So the beginning value, sorry, the ending value 3,005 divided by the beginning value of 2,500 to the power of 1 divided by n, which is 2 years for stock A. So that's why we have 1 divided by 2. And if you use your calculator, you should get this much, 1.1832. Okay, 3,005 divided by 2,500. Okay, ni power to the power of 1 divided by 2. Kuasa 1/2. Alright, and to get the HPY, annualized HPY, simply minus 1. So minus 1 would be 0.1832 or 18.32%. So meaning for this stock A, okay, the annualized return would be 18.32%. Okay, 18.32%. Right? For stock B, right? Similarly, the formula is the same, right? So the ending value for stock B, I wrote here 1,002. And the beginning value was 1,000. Okay, so 1,200 divided by 1,000 to the power of 1. Okay, and divide by, for this, the end is 6 months. Okay, when it's wrote here 6 months, don't put it 6 here, because the end is in years. Okay, the end must be in years. So if you put it 1 divided by 6, okay, the formula will assume that 6 equivalent to 6 years. But for this question, it is actually 6 months only. So therefore, you have to convert these 6 months into years basis. So how to get in years? So 6 months, you have to divide by 12. So you divide by 12, then you get 0.5. Okay, so you put this 0.5 here, okay, instead of 6. Okay, so kalau 4 months, then you divide lah 4 divided by 12. So you dapat 0.3, for example. So you put here 0.3. Right, so for anything more less than 1 year, okay, anything less than 1 year, you just need to divide by 12. Okay, divide by 12. So for this question, 6 months, so 6 divided by 12, you get 0.5. So you put it here lah, 1 divided by 0.5. Okay, and based on this formula, you get 1.44, and to convert it in percentage, just minus 1, it's 44%. So here you can see it better lah, which is actually more profitable. So if you don't use this formula, okay, some people might see, stock A is better because the returns are higher. Okay, 2005 then increase to 3005, so it's a 1,000 profit here. But for this stock B, it is from 1,000 and then just up to 1,002, just a 200 ringgit profit. Okay, but remember we have the time frame elements. Okay, for stock A it's 2 years, but for stock B it's just 6 months. And on top of that, the value of investment is not the same. 2005 is higher. It's supposed to give you more returns as compared to this 1,000 ringgit. So therefore, this might blind someone in terms of their decisions to see which is more profitable. So therefore, to make comparison, okay, this is a good example how to see which investment will be more profitable. Okay, more profitable. In this case, stock B, okay, is more profitable because the return is higher, 44% as compared to 18.32%. And remember, this is annualized per year basis. So therefore, it's 44% per year. And this is 18.32 per year. Right? So this is we have so far HBR, HPY, annualized HBR, annualized HPY. So we have 4 so far. Okay. By the way, if you have any questions, just let me know. I on mic semua kan. Saya cakap seorang ni. Recording pun already on. Okay, suppose you have a set of annual rates of returns. When we say set, meaning is multiple, multiple, which is more than one. Okay, more than one annual rate of returns. For example, you have 5 years of data, for example. Okay, so how to measure the mean, okay, or the average? Okay, how to measure the average of returns, right? So here you can see we have 2 measurements of mean, the average. Yeah, I think you've learned this somewhere before, supposedly lah. If you've learned business mathematics, okay, you're supposed to go through this kind of calculations for average. So we have 2 means, which is the arithmetic means, acronym SEM, and we have geometric mean, or the GM. Okay, slightly different formulas, slightly different information required for the calculations. Okay, so let's look at the easier one, which is the arithmetic mean, AM. Okay, this is basically the simple average. Name pun simple, right? Okay, so this is the basic average that I think everyone knows how to do it. Okay,
Excuse me,
basic.
sir.
Sorry?
I want to ask something.
Okay.
Actually, what is the purpose of measuring the mean annual return?
Let's say if you have multiple years of returns, right? So you need to sometimes to report what would be the average score after 5 years of investment, for example, to give the investor. Let's say you are portfolio managers, right? So you have a record or historical records of past 5 years returns. Okay, so to give better understanding to your client, for example, so for the past 5 years, our average would be this score, contohnya. So that's why sometimes we need to have this average returns presented to either the clients or it can be to the managers, to the bosses, and whatnot lah. Okay. Okay, coming back to this arithmetic mean, yeah. As I said, this is just a simple average calculations. Okay, and in fact, most of the people, okay, for the sake of presenting the average, might use this approach of presenting data because of the simplicity of the concept. Right? Everyone will definitely understand this. Okay, so the formula would be the sum of HPY. So we use HPY here. And if you recall HPY earlier, it is based on percentage already. Okay, so simply sum all of the HPYs. If you have more than, obviously it must be more than one lah. If one, why we need to calculate average, right? So it's a multiple of HPYs, and we divide with n, which n represents the number of years that you have, the data. Okay, if you have 4 years of HPYs, for example, so the n would be 4 as well. Okay, so you just add all 4 and then divide by 4. Then you get your simple average or the arithmetic mean. Okay, but on top of that, alternatively, we have another set of mean measurement, which is in the form of geometric mean or GM. So here, the formula you can see here, this is pi. Okay, pi or represents the product of all annual HBR. So instead of HBY, geometric mean use HBR. Okay, the one with point form, the 1.14, 1.44, and that the HBR. Okay, and when I set product of all, this is product of multiplication. Okay, we have to multiply all the HBRs. Okay, multiply all HBRs. And then, okay, this is quite similar as our HBY before. To the power of 1 divided by n minus 1. Then we get our geometric mean. Okay, and n here represent the same thing, number of years. Okay, so this part is actually similar like our HBY. Okay, similar. In fact, the whole thing is similar, we have to multiply all the all the HBRs. Okay, I'll give you an example like this. Okay, suppose you invested 1,000 ringgit 3 years ago. So this, again, this is your beginning value. Okay, beginning value for the first year, okay, which is represented here. And 3 years ago, and it is now worth 1,104, which is this part, the ending value at the end of third year. So the information below shows the annual ending values and HBR and also HBY. Okay, so for this average, okay, for this average, the HBR and HBY can be calculated individually, right? Individually. So this example illustrates the computation of the AM and GM over a 3 period of investment. Okay, so this concept, we have the beginning value and ending value. As you can see here, the ending value of the first year will be the beginning value for the second year. Okay, concept of similar if you've learned accounting before and we have the carry forward values. So this ending value will be carried forward next year. Then we have ending value. This will be carried forward the following year, for example. Right? And these values, okay, obviously can be calculated based on our formula earlier lah. So for example, 1150 divided by 1000. Okay, you dapat 1.15. So minus 1, 0.15. Okay, so let's say if you want to calculate AM, arithmetic mean. So if you remember, the formula is based on HPY. Okay, based on HPY. So it would be 0.15 plus 0.2 plus a negative 0.2, and you have to divide everything by 3 because we have 3 years here. Okay, so 0.2 minus 0.2, so we knock off each other, so it's 0.15 divided by 3. It will be 0.05 or 5% average. So for this investment, okay, for this investment, the average mean would be 5%. So on average, on average basis, the investment would be 5%. Okay. Okay. For the GM, geometric mean, yeah. So for geometric mean, the formula is the product of HBRs, okay, product of HBRs to the power of 1 divided by n minus 1, okay, which is, I can write it here, 1.15. Remember, we use HBRs, not HBY. AM, we use HBY. GM, we use HBR. So multiply with 1.2, then multiply with 0.8. So, okay. And this is to the power of 1 divided by 3 minus 1. Okay. The whole thing here to the power of 1 divided by 3 because n is 3 years, minus 1. So 1.15 times 1.2 times 0.8. Okay, to the power of 1 over 3 minus 1. So here you get 3.35%. I put it here, 0.035 or 3.35%. Okay, 3.35%. So this would be the difference between AM, arithmetic mean, and the geometric mean, 3.35. Okay, double check that.
Doktor,
Ya,
contohlah kan kalau macam ni kan, dalam soalan dia suruh kita kira dua-dua, lepas tu buat comparison ke ataupun salah satu?
it can be anything. Sometimes they can ask you, okay, calculate AM, second, calculate GM. Boleh mana-mana.
Oh, okay, okay.
As long as you can differentiate lah. Kalau dia suruh calculate AM, then you calculate GM, then salah lah. So, just because you tanya tu tadi, let me share. I shared with you this question juga, this set of questions. So macam ni lah contohnya for question 1 A3, you can see right, I share the screen. Okay, so the question asks, okay, find the arithmetic mean, then find the geometric mean. So they can ask you both, right, depending on the question. Okay, so just be careful lah, which one to use. Alright, so to conclude this, to compare between AM and GM, as you can see here, AM slightly higher as compared to GM, the score, ataupun the average. It's already here, the answer. So for the comparison between AM and GM, so if the rates of return are the same for all years, okay, meaning it's constant, if the returns are constant, then the AM and GM will be equal. There will be no difference. Okay. However, most of our calculations, the rate of return will be different for each year. Okay, just like we had this question again. So the returns are different every year. So once this is the case, okay, automatically our AM will always be higher than GM. Always. Okay, just like what we have here. The AM is 5% and the GM is 3.35%. Okay, so if the returns are not the same, automatically the EM will always be higher. Okay, so why we have two? Again, the two comparison. For EM, mostly best use as an expected value, and this is usually good for short term. Okay, short term measurement. Okay, you want to take a look from short term period of time. EM might be useful for that case, but GM is best used if you want to measure long-term performance. Okay, maybe 10 years or more, right? Because the fluctuations, right? When we talk about fluctuations, right? Sometimes GM is much better comparison tool as compared to EM, because EM sometimes can be misleading if there's let's say we have a very high performance for that one particular year, and because of that high score, you can pull up all the scores to be nampak macam better performance, but sometimes it's just one-off new performance. So therefore, for long term, GM is much more useful in terms of comparing the results ataupun the assets returns. Okay, the asset returns. Okay, so just one more. Bukan one more, dia ada banyak lagi, but the extension, okay? Earlier when we calculated the HBR and HPYs, okay, in fact, during my first example tadi pun, that we have 30 cent dividend tadi kan, I said we ignore the dividend first. But when we want to calculate the actual HBR and HPY, we actually needs to take into consideration the income, which is either dividend or interest. Okay, we need to incorporate this as part of our returns as well. So that's why, okay, the extension of the formula is this part. Inilah part ini. Okay, so basically it's similar like before. What we need to do is just to add the income part, okay, together with this ending value, and we divide with the beginning values to get the HBR, and again we minus 1 to get the HPY, the percentage. And again, okay, this is tak ada kat sini for annual HBR, okay, it more or less it's supposed to be the same. So meaning it will be EV plus income divided by beginning values. Okay, so put a bracket here, can do it. It's 1 divided by n minus 1. So sorry, ini untuk HPY. Kalau HBR meaning without this one lah. Okay, I pun dah salah tulis. Okay, this is HBR. Okay, without this one. To get annual HPY, then you use HBR minus 1. Okay, so this is HBR. Then you minus 1 to get annual. HB for annual lah. Okay, so this part, yeah, I wrote with my pen here, it is basically the same as before, as the earlier. Again, the difference will be just the income portion. Okay, the income portion. So let's look at this example now. Okay, so we have 3 years. Okay, 3 years of returns, or 3 years or returns with difference beginning and value. So again, see the concept of the ending value carry forward to the following year to be the beginning values. And we have dividend per year, 30 cents, 50 cents, and 80 cents respectively. Okay, so for this, the question already gave us the answer. Okay, so to get this HBR, okay, for this, for example, it's supposed to be, I just wrote it here lah, for this first year. It's 3 ringgit 50 cent plus 30 cent divided by 320. Okay, 320, then you get 1.1875, okay, which is this one. Okay, and then minus 1 to get 18.75. So you need to do it for all. Okay. Okay, just like I said, this is an example, so dia dah bagi jawapan here. But most of the time, if the question, they will stop until dividend je kot. And HPR, HPY, you need to calculate yourself. Okay, and similarly, the question also calculated the AM and GM as well. So HPY is 18.75 plus 31.43 and 29.27 divided by 3 because we have 3 years. So it's 26.48%. And for the GM, it's multiplication of these 3. Okay, to the power of 1 divided by 3 minus 1. Okay, so you get 26.36%. Okay, so as you can see here, GM is lower than the AM. Okay, because again, the returns are different every year. But can we calculate AHPY, for example? Yes, we can. Kalau kita nak calculate lah, AHPY. Okay, the answer might be similar like either of these two. So we take the end value for the whole. When we talk about annualized HPY, we're gonna look at the whole picture. We're not looking at every layer like average. You're going to look at the beginning and ending value at the end of year 3, and then we annualize it later. So meaning the ending value is 450. And the dividend, so since we have 3 years of dividend, so we have to accumulate all 3. So berapa ni? 30 cents plus 50 cents plus 80 cents. So we have 1 ringgit and 60 cents income or dividend. and the beginning value was 3 ringgit and 20 cents. Okay, so you need to annualize it by 1 to the power, to the power of 1 divided by 3. Then you minus 1. So 4.5 plus 1.6 by 3.2 to the power of 1 divided by 3 is 1. Okay, times 100. So you get around 23.99%. So this is based on this annualized value. So you can see we have 3 different rates here. Okay, this is based on average. This is based on annualized amount. Okay, so we have 3 different data to present. Okay, so it all depends on the question. So the question might ask all 3 pun. Okay, might ask all 3. Okay.
Nak tanya boleh?
Ya, boleh.
Okey, yang berdasarkan semua sebagi contoh ni, nilai EV lebih tinggi daripada BV. Ada tak situasi yang di mana nilai EV tu lebih rendah pada BV?
Ada. Obviously, this is based on best case scenario lah. Mana all our investment shows a profit. So if the other way around, so meaning you might have a negative values because you rugi, kan? So there's a possibility that the EV is lower than BV, of course. Okay, with this example so far, I've showed you all the profits lah. But some might have a inverse results because of the EV is lower than the BV. Yalah, because in stocks market, for example, you purchase at 320, tak semestinya dia akan goes up all the time. Sometimes it can go down. So if that's the case, then yeah, you can calculate juga lah. So don't switch the position. You just keep it the same formula, and then you will see lah the result nanti will be might have a negative values. Okay, just like ni kot tadi. Macam ni ni kan. Kalau kita calculate from 1380 and then dia reverse to 1104 kan, so it's a reduction here. So that's why we have a negative values kat sini. Okay, it's possible, yes. If you ask me, yes, it's possible. Ada soalan lain? Okay, so I'm gonna skip this one. This is basically the one that we've done so far. So I just want to recap. Okay, ni pun kita dah calculate. Just like what we've done with the arithmetic mean tadi. Okay, this is basically arithmetic mean. So as a recap, what we've done, okay, you need to remember the HBR, HPY, especially sebenarnya you nak ingat HBR, HPY yang ni je sebenarnya, with the income. Okay, because in investment, okay, most of the investment will include together with the possible dividends, for example. So just remember this part, because if let's say lah, the income is not provided in the question, we know lah income will be 0. So it's still EV plus 0, which is EV, divided by BV, which is the earlier or the first formula. So might as well you just remember this one. Okay, EV plus income, if any, divided by BV, and then minus 1, okay, to get it in percentage for HPY. Remember the annual HBR and HPY, whereby what you need to do is to extend it by adding the power of 1 divided by n. Okay, here, right, to get the annual HBR, and minus 1 to get annual HPY. And then you have the 2 means tadi. Okay, the arithmetic mean, AM, and the geometric mean, GM. So far, that's how we calculate the returns. All of these are still returns. Okay, returns. Any other questions? Okay, I'm gonna let you guys break for a while. But at the same time, I will share with you this question tadi. All right, so have a look. Okay, this one I also shared already in the folder. If you downloaded your files for the notes, okay, you're supposed to see this as well masa tu. Some exercises lah for topic number 2. So have a look at this question. Okay, kalau you rajin, you can try. Okay, and in fact, after we datang balik after the break, I'm gonna let you guys some time to try this. Okay. Okay, we have multiple of information here. We have here, we have the beginning price, but no ending price. Okay, I gave you hint just now. What's the impact of beginning price? And it also give you cumulative dividend. Okay, so the difference between the example and this one is the word cumulative as compared to this one. This is dividend. So what does it mean dividend? This is on that year's punya dividend. Okay, but for this question, this is cumulative. Cumulative maksudnya terkumpul. So meaning each year ni is cumulative from the previous ones. Okay, so try first what you understand with this. I dah bagi you hint. So you need to know the ending as well. Okay, and then the dividend you need to figure out lah the actual dividends. And the question asks you to compute the HPY for the year 2011 and 2014. So just like this one, you know HPY, but you might need to calculate HBR juga because the question asks you to calculate AM and GM. So AM and GM require HPY and HBR. Somehow you need the HBR as well. Okay. And on top of that, they ask you to calculate the AHPY, the annualized HPY as well. Okay. So never mind. We take a break, let's say for 10 minutes until 5:40. And then I will restart. And I give you another 5 minutes katakan. So a total of 50 minutes lah from the break ni. Maknanya 5:45 we try to discuss this. Okay, 10 minutes break and also 5 minutes to try to answer this question and then we will discuss. Okay, so I'll see you in 15 minutes. All right. That's right. Okay, maybe I can ask you satu je. What would be the HPY for 2011? HPY for 2011. Siapa dapat tak? Yeah, 32.35%, yeah, correct. For 2012?
16.67.
15,
16.
16.37. For 2012?
16.67.
16.67, yeah, 16.67 lah. Ada jawapan lain? Any other answers? Slightly different from mine.
10%.
Come again?
10.
10. Exactly 10. Okay. Slightly higher than mine. I don't know kalau you round up lah. Maybe you round up good. 9.52, yes. 9.52 is correct. Just keep it, like I said, for HPR. So maybe you can use 4 decimals for HPR because we will convert it into percentage later on kan, for HPY so that we can have at least 2 decimals like 9.52 for HPY. So perhaps yang you dapat 10% tadi, if you round up lah, maknanya if you use HPRU 1.10 kan, so kalau you round up, then you get 10%. Yeah, 10%. But to make it precise, make HPR 4 decimals, and then HPY 2 decimals. Right, so 2013, yes, 9.09, correct. And lastly, 2014, okay, because the question asked us to find until 2014, yeah. So 2014, 14.89, yes, correct. So that's our HPYs for 4 years, from 2011 until 2014. So berapa tadi? The first one was 32.35, and then 9.52, 9.09, and lastly 14.89%. Okay, so that's number one, the holding period yield, the HPY for all 4 years. Second one, okay, the annualized HPY. Okay, I've shown this in previous example. Okay, so what would be the AHPY? Okay, so if you remember the HPY, we need to have the ending balance. But since we are calculating from 2014, so you have to make it consistent. Okay, so we're going to use the same information for all the other three. Okay, so meaning the ending balance still would be 260. Okay, the ending balance for 2014, ending balance for 2014 would be RM2.60. And we need to add the dividends. Since this is cumulative, so the cumulative until 2014 was 40 cents. Okay, 40 cents. So 260 plus 40 cents and divide by the beginning price of 170. And then we use the same thing, divide by to the power of 1 divided by 4. Okay, because we have 4 years. And then minus 1. So here I get for number 2, 15.26%. So be something like this, maybe I erase balik ni. Supposed to be like this, RM2.60 plus 40 cents divided by 170 out of 1 divided by 4, because we have 4 years, 11 until 14, then minus 1. That's why I get 15.36%. Okay, so next, AM, Arithmetic Mean. So this is very simple. You have all the HPYs. In fact, your friend tadi pun dah share HPYs. So what you need to do, you just add all 4. Okay, 32.35 plus 9.52 plus 9.09 plus 14.89, and then divide by 4. Divide by 4. 2.35 plus 9.52 plus 9.09 plus 14.89. 4. 16.46. So for AM, I get 16.46%. Okay, for AM, 16.46%. And for GM, actually mean, what you need to do, that's why I asked you to calculate the HPR as well, because we need HPR for GM. So you just multiply all 4 HBRs. And again, use the power of 1 divided by 4 minus 1. So for GM, get 16.10%. See, yeah. Let's save dalam. Put something as if I have deleted. Never mind. Okay, so that's the answers for all lah. 1, 2, 3, and 4. All right, any questions for this? Very straightforward. All right, so let's move on. Okay, let's move on. 6 already. So this one already done. So now we want to take a look at okay, portfolio ni tak ya, because we're gonna talk about portfolio returns later on. Okay, I mean in topic number 3. So now let's move on to risk. Okay, we have returns. Okay, I recap. We have HBR, HBY, annualized HBR, annualized HBY, and then AMPM. Okay. Now we want to look at the risk elements. Okay, so what is risk? Okay. So in previous examples, we discussed the realized historical rates of return. Okay, but as an investor, it is more meaningful for them to know the expected returns, okay, based on future risky investment. So we have to take into consideration the risk element. If you notice earlier, whatever we've done so far, based on HBR, HBY and whatnot, we just calculate based on historical returns without taking into account the risk factor. Okay, so those are basically based on historical data, and that's it. We analyze. But when we talk about forecasts, okay, future, we need to take into consideration the risk factor. Okay, the risk factor. So what is risk? So risk refers to the uncertainty. So this is a keyword always used when we talk about risk. So uncertainty of the future outcomes. Okay, and as you all know, the future outcomes is always uncertain. We cannot predict the future. That's very, very basic. I think everyone we should agree with that. We cannot predict the future. Okay, but we can forecast with a certain element of discrepancy of your projection. And discrepancy itulah dipanggil risk. Okay, the uncertainty of a future outcome, and compare it against your predictions. Okay, kita boleh predict. Okay, but sometimes the prediction tu can go above or below your expectation lah. Okay, so there are many possible variation of returns from an investment. Okay, when we talk about investment, obviously the variation would be many possibilities, okay, due to the uncertainty. But in our case, okay, when we talk about exams, for example, usually we will put at least 3 variations. 3 variations, okay, which is also known as the probability. Okay, the probability or the chances or the likelihood of an outcome. Okay, so 3 examples. Contohnya, best case scenario, normal, and worst case scenario. So this is example of 3 variations or 3 probabilities that your projections so might happen in the future. Okay, kalau based on best case scenario, meaning during the economy is very good, then you can get a certain returns. Okay, in normal case, okay, when the economy is normal, nothing bad, nothing good, then you akan achieve a certain returns. Tapi kalau let's say now, Okay, now is an example of a worst case scenario maybe. During the pandemic, tiba-tiba ada you know, the pandemic hit the economy and our return will be at the worst case scenario, which is the minimum returns, for example. Okay, so this is the three variation or the three probabilities when we want to make predictions based on risk. Okay, and the larger the variation indicates the higher the risk. Okay, and we can measure this, or we can put a weight for all of these scenarios. Okay, and the total weights of, let's say we have three, we can have more than three, but in our cases, like I said, for exams or for tests or for whatever reason, usually we will put at least three. Okay, at least three. So let's say three macam ni. The total weight of all three scenarios here must be equal to 1. Or if you want to convert in percentage, it must be equivalent to 100%. Okay, maknanya if you add all three, the sum of, when you add all three punya probabilities, it must be equal to 1. For example, okay, when you do predictions for the future, you said, okay, based on best case scenario, the chances to get that high returns maybe around 0.2. 0.2 equivalent to 20%. 20%. Okay. Normal cases, okay, you should earn ataupun you can get this easily half chance, meaning 0.5 or 50% chance. Okay. And based on the worst case scenario, okay, since this is, when you add these two, it's already 70% again. So this automatically should be 0.3 or 30%. So when you add all three, this probability, the total will be 1.0. Okay, so that's what is meant by the sum of probabilities must equals to 0. Sorry, to 1.0. Okay, but you don't have to worry about these probabilities because if we look at the question, these probabilities will be given in the question. Okay, no worries about that. But anyway, this sum must be equals to 1 or 100%. Okay, but like I said lah, the higher the values, the higher the chance, the higher the risk juga lah. Okay, so when we calculate the returns with the element of risk, now we have another measurement. Okay, because now we have probabilities already. Since we have these probabilities, we have to incorporate this in our calculations. Okay, in our calculations. Right? So the risk expected reflect the degree of uncertainty I have already mentioned. So here, later on, we will measure the returns with the element of risk in this form, whereby we put the acronym of ER, which is the expected returns. Okay, this going to measure the expected returns. Okay, so this is the formula of expected return, ER. Okay, whereby it is the sum of, okay, the symbol sum. Okay, the probability. Remember, we have example tadi, we have 0.4, 0.5, 0.3, and whatnot lah. Multiply with the possible returns. Okay, with the possible returns. So this is our expectation of the returns. And then if you have three, like I said, if you have three scenarios, so you will have three probabilities with respective possible returns. Then you add all three to get the total of ER. So this ER is actually just like an average, actually, to be honest with you. This is actually like an average of returns, but this is based on what we call as weighted average. Okay. If you remember earlier, we have arithmetic mean again, whereby it is based on simple average. Here, we're gonna use the weights. Weighted. Okay. And what are the weights? These are the weights. The 0.4, 0.5, 0.6, whatever percentage, so that's the weights. And we multiply the weights with the returns in order to get the average score. Okay, okay, so this is one example to illustrate, but with the answer obviously, but how to actually measure this. Okay, so we have three stage of economy. Okay, like I said, at least 3 probabilities. So we have 3. Just like I mentioned earlier, we have, let's say this is good equivalent to best case scenario. Moderate is normal. And then we have poor, which is worst case scenario. Okay, and we have 3 weightage of the probabilities. And all 3 must equate to 1.0. So you add all 3, it's 1.0. So you don't have to worry about this, but just check. Takutlah soalan salah kan. Just check, it must equivalent to 1.0. Okay, so to get the ER, what you need to do is basically multiply respective probability with the respective returns. So for example, 0.3 times 13%, okay, you get 3.9. Okay, 40% times 9, okay, you get 3.6. 0.3 times 6 is 1.8. So when you add all 3, so here you can see the score is 9.3%. Okay, so somehow it is like average, like I said. You can do simple average by adding all 3 and then divide by 3 to get arithmetic mean, kan? But based on risk element or probability, we cannot do that. We have this weight. Okay, therefore we need to multiply first, then baru kita add everything to get the simple average. Oh, sorry, the weighted average. Okay, which is 9.3. And this is our ER, expected return. Okay, and this concept ER will be used again in our topic number 3, which is based on risk and return for portfolio. Remember, this is risk and return for one single instrument, which is dalam case ni stock B alone. Okay, we're gonna calculate ER later on for a portfolio as well. So if you have a series of investments, so meaning you have stock A, B, C, and D contohnya, then we can calculate the ER for all portfolio. Okay, the portfolio which consists of 4 stocks. Okay, and again nantilah when we talk about it in chapter number 3 next week. Okay, but this is ER. Okay, and this will be used again lah, like I said. So this is the return. When we talk about the risk factor, we have to calculate the weighted average of risk, return based on ER. Okay, but now let's move on to the actual measurement of risk. Okay, actual measurement of risk. So in these notes, okay, we have 2 sections of measurements of risk. Okay, the first part is actually based on a series of data, whereby we have a time series data. Time series, Okay, time series whereby we have just what we had earlier, yang ada, let's say from 2011 until 2014 data, contohnya. And we can calculate the element of risk, which is we have here, number 1 is variance, for example. Okay, and to get this, it is based on this formula lah. Okay, but tell you what, for this semester, I'm gonna skip this. Okay, I'm gonna skip the time series measurement. Okay, but instead I will go straight. Okay, bear with me. Nanti I can go back to this one. I will go straight to this one, measuring the risk. Okay, based on the ER. So this is your ER tadi I mentioned, expected returns. And we're gonna measure actually the same thing as before, the 3 elements, okay, of the variance, the standard deviation, and the coefficient of variation. The same 3, but slightly different formula, because when we talk about the risk of expected return, okay, we know we have the probability. Okay, so we're gonna use this concept instead. Okay, yang tadi lah, yang 0.3, 0.4, whatever tu kan. So you're gonna use this one. So in terms of measurement still, the measurement of risk, we have variance, which is symbolized with the symbol sigma. So this is sigma. Sigma squared. Sigma to the power of 2. Okay, that's variance. Next we have standard deviation, or SD, standard deviation. And the symbol is sigma, just sigma. So what does it mean? So if you look at this variance, it is sigma squared. This standard deviation is just sigma. So therefore, if you have variance values, so to get your standard deviation, what you need to do, you just need to square root of variance. Then you get standard deviation. Okay, similarly, if you have standard deviation, okay, what you need to do is to square the standard deviation to get variance. Okay, so whatever amount you square or you power 2 to get the variance. Okay, so variance and standard deviation, you can find each in one or another if you have one of the values. Then you can interchange the information. Okay, but for our case, most of the time, we need to calculate the variance first. We need to calculate the variance, then we can calculate the standard deviation. And lastly, number 3, we have the CV, the coefficient of variation, or in short, CV. And all of this can measure the risk factors for our investment. So for the risk factors, the higher the scores, all of 3, the higher the scores, the higher the risk. Okay, the higher the risk. Okay, you can read balik kat sini nanti lah. Alright, for example here, standard deviation measures dispersion written from the mean, from the average. Okay, so the larger the dispersion, the smaller chance to achieve, therefore the higher the risk. So dispersion tu maksud dia macam ni. If you have an average like this, let's say this is the average return. So the dispersion tu dia akan goes up and down. Kalau small macam ni, slow risk. Tapi kalau dia goes up, it goes down like this would be the higher SD, standard deviation. So meaning you cannot predict the price variation. Okay, how to make money if you have this kind of long dispersion ataupun big dispersion kan. So this is low standard deviation. So this is high standard deviation because they deviate from the mean. Okay. Similarly like CV lah. CV also a measurement per, risk but based on per unit basis. So that's why the standard deviation divided by average return. So it's the same thing lah. The higher the CV, the riskier the investment. Okay, but don't worry about this formula. We're not going to use this one, but we're going to use the formula based on the ER concept. Okay, so what would be the formula? Let's look at the first one, the variance. Okay, so you can see the similarity in terms of the information. Okay, kita still ada probability, just like what we did for the ER. Cuma kalau tadi kita ambil ER and then we multiply with the possible return. But now, we adjust a bit our formula, whereby we not simply multiply with the possible return, but instead, you find ataupun we multiply with the difference. So that's why the name variance, they try to find the difference between the two rates. Okay, possible and also this is ER, expected return. Remember, this is our ER. So how to find ER? Is from the average that we've calculated earlier, right? And squared. Okay, why we have squared? Because there's a possibility that your possible return is lower than your ER. So therefore you get a negative here. Okay, you might have a negative here. So in order to avoid the negative value, that's why we square the values. Okay, to knock off the negative sign. Okay, and then we add all, so we sum. Similar like our ER earlier. Okay. Okay, let's say we go back to this one. Let's say we're going to use this one as our example. Bear with me 1 second. Yeah, I need a whiteboard. So I'm going to copy this. Give me 1 second. We have good. We have moderate. And then we have poor. Okay, the probability, it's 0.3, 0.4, and 0.3. And the return is 13, 9, and 6. And our ER earlier was 9.3. Okay, so this is information that we need. Okay, I'm not showing you the ER again, but in normal question, okay, ER will not be given, so you need to calculate ER first, obviously. Okay, you need to find your ER first. And if you go back to this first measurement, which is the variance. So if you want to find the variance, okay, based on this question. Okay, so this is the formula, right? So usually I like to use like a table format sometimes, right? But yeah, it's up to you. So the formula, if you look at this, is actually 0.3 probability. You go by line, by line. So 0.3 multiply with the difference of possible return, 13%, minus the ER, 9.3%, squared. Okay, plus the second line, 0.4, multiply with the difference of 9% minus 9.3, squared. And last one is 0.3, multiply with 6%, okay, minus with 9.3 squared. As you can see here, the two lines below here will be negative, right? So if you don't have this negative sign, so nanti kita multiply will be negative, 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 then yeah, we don't want negative variance. We don't have even. Variance should be positive values. So therefore, if you have your calculator, 13 minus 9.3 squared, 3. So you will have 4.107 here, plus 9.3 squared, 0.4, 0.06, lastly 6 minus 9.3 squared, 0.3. So you're gonna have 3.267 here. So you add all 3.036 plus 4.7. So you have 7.41. So this is not percentage here, you don't put percentage. So you just put 7.41. Okay, because if you use calculators, for example, you might have 0.007, something like that. Okay, so but since we are using calculators, just put 7.41. 7.41. Okay, without percentage, without the percentage. So this is a measurement of variance. Okay, so the probability, each probabilities, since we have 3 probabilities, right? Multiply respectively with the possible returns for all 3, 13, 9, and 6 is from the question. This is from the questions. Minus with the ER. ER kita calculate earlier. And because of this, make sure you calculate your ER correctly. So if your ER is wrong, based on your first calculation, then all of this will be wrong automatically, unfortunately. Okay, so just be careful. Calculate the ER correctly, then use it in our variance. Okay. Next, we move on to standard deviation. Okay, so if you remember the formula for standard deviation earlier, I said it is the the square root of variance. Okay, the sigma alone without this. Kalau ni tadi sigma squared kan, standard deviation is sigma. This one, sigma only. So meaning in order to get standard deviation, we need to square root our variance because our variance is sigma squared. So therefore, it's square root of 7.41. Take your calculators again. Hopefully you know how to use calculator lah, to square root. I assume you know. Okay, so you get here 2.72. Okay, 2.72 standard deviation. So is it good, is it bad? We are not so sure. Okay, because again, this is based on single security. So we don't have a point of reference to compare. So that's why later on when we do for portfolio, right? So when we do individual stocks, when you're either variance, standard deviation, then you can see which investment is higher risk as compared to the others, because then we can compare the standard deviation of stock A, B, C, and D, for example. Okay, but for this single security, we are not sure whether it's high or not in this case. So this is again relative. Okay, and the last one is CV, coefficient of variance. And the formula for CV is this one, standard deviation, which is 2.72. We divide with the ER. Okay, the expected returns is 9.3 just now. So you get 0.29. Okay, 0.29. So this is our coefficient of variation. Okay, so this is how we measure our risk. Remember, these three, variance, standard deviation, and coefficient of variation, all are measurements of risk. Okay, so depends on the question. So if the question asks you to find variance and standard deviation only, then just calculate the two. Right. Okay, so just to let you know, in the notes just here, this is based on time series. If you recall here, this is not probabilities and this is period, year. So as I said, I will not use this one in my question for this semester. So you don't have to worry about this one. So that's why for the example just now, I don't calculate this one, but I calculate this one. And for stock B, okay, with the same probabilities and returns and the ER just now. And this is the answer tadi lah. Our ER, our variance, our standard deviation, and our CV. Okay, our CV. Okay, so that's the measurement of risk that we want to talk about for today. So as a recap, right, we have the first part just now, we have the HBR, HBY, annualized HBR, HBY, EM and GM. Okay, but that one without the element of risk. Okay, meaning we just calculate the historical returns alone. But based on forecasting or measuring for the future, we have to incorporate the risk factor in our calculations. So therefore, we have the return in the form of ER. And then for risk, we have variance, standard deviation, and coefficient of variation, or CV. Okay, for single security, that will be all for our measurements. Okay, but later on, when we're gonna measure based on portfolio, based on a group of investments, we're gonna have another set of measurement. Okay, we still have ER, kita akan ada ER sama je for returns. We're gonna have same or similar, like I can say, measurement of risk. We have still, let's say, variance and standard deviation, but we're gonna have additional measurement, which is we want to see how the investment in that particular group react between one and another. Okay, so later on, nanti you will see another two measurements. We want to see when we talk about the interaction between the investments within the group. So you will see correlation and covariance. Okay, so the two we will discuss in topic 3 next week. Okay, so the rest is actually more on theory part, how we determine the required rate of returns. Okay, so here, as you can see here, there are 3 components when we want to try to measure the required rate of returns. There are 3 factors. Okay, which is the concept of time value of money, right? If you recall, you've learned financial management before, right? So the concept of a ringgit today is not the same as a ringgit in the future, because that value of ringgit can be invested and generated in the future. So you need to incorporate the time value of money concept. You need to know the inflation rate and obviously the risks involved. And then we can incorporate everything to be our required rate of return, or the ER tadi lah. Okay, the inflation rates, or not the inflation rate, sorry. When we try to estimate the required return, so obviously there will be complications, right? And these are, I'm not going to touch in detail about this one, risk-free rate, because we're going to use this risk-free rate nanti when we talk about dalam topik apa, the capital market. Okay, the capital market. We're going to talk about risk-free rates. Okay, so we have two types of risk-free rate here: the real risk-free rates and the nominal risk-free rates. So what's the difference between the two? For real risk-free rate, they assume no inflation. Okay, so meaning that there will be no inflation, which is not true. Walaupun itu real, but it's not true. Obviously, in the market, there are always inflation rate, but in economy, we have to make assumptions. Okay, so the assumption here, there will be no inflation rates. Okay, so you don't have to worry about all of this formula yet. Okay, and any other factors lah kat sini, if you read on your own. Right. Yeah, I'm not going to talk about this today. And as a summary of the risk and return, this is using the SML. Again, you akan nampak ni again in our capital market punya topic. Whereby in the SML, security market line, the risk and return can be measured using this diagram. Okay, so the y-axis here is the expected returns, or the ER. And the x-axis ni would be the risk. Okay, so, and it will be represented by a single straight line. Okay, single straight line, increasing line. Okay, and as you notice here, it's not starting from zero. Okay, it will start somewhere on top here. Maknanya there will be no investment with zero returns. There will be some secured or safe investment that will give you a minimal returns. Hence, dia letak kat sini nominal risk-free rate. So what does it mean by nominal risk-free rate again? Tadi kalau you perasan, it is types of investment with risk-free element. Risk-free, maknanya zero risk kind of investment. So in Malaysia, when we talk about risk-free rates, okay, risk-free rate, you've learned banking last semester, either with me or either with Dr. Azianti. In Malaysia, risk-free rate can be measured using money market instruments. Okay, money market instruments. So example, okay, example of money market instruments for representing risk-free rate would be instruments like MGS, Malaysian Government Securities, for example, or if it's in Islamic contracts, they might use MITB, Malaysian Islamic Treasury Bills. Or kalau conventional dia T-bills lah. If it's conventional, Treasury Bills. Okay, and these two are example of instruments that can represent risk-free rate. So meaning if we invest in either of these two, because this is government issued, so every government issued instruments are considered risk-free investment. So these two, let's say lah, MGS rate dia 2%. So this would be 2% lah here. Okay. And the higher the risk, you should earn more than 2%, for example. Right? So this slope will indicate your required risk or return based on the risk basis. So the higher the risk, obviously you expect the higher the return. Okay, just expect it, but it not necessarily will happen. It depends on the situation. So for low risk, for example, you're gonna have investments such as fixed deposit will be here. Okay, fixed deposit maybe around 3 to 4%. So dia akan ada slightly above with the low risk element. Okay, kat sini. For average risk, maybe you can put here bond or unit trust. Okay, so this would be the average risk. Okay, so the risk, the return will be slightly higher, but with a higher risk. Okay, for high risk investment, obviously stocks, stocks or derivatives. Okay, will be part of high risk investment. Okay, and this stock return can be again as high as, I don't know, there's no limit on stocks. You can earn double-digit returns. Okay, if you are lucky enough to gain that returns lah. Okay, so this is the relationship lah between the risk and the return. All right, so I'm not going to talk about this. So with that, I think I'm going to stop here. 6:30 already. All right, so any questions, any final questions for topic number 2? By the way, I'm not sure whether you're aware or not, ataupun you've visited my guru recently or not. I just realized like last week, there's one section in web conferencing. In the web conferencing, I'm not sure whether it's new this semester or last semester. I don't think so last semester ada, but there's a section in the web conferencing whereby there's a video link there. Okay, in my guru, again, I'm not sure that, I think more or less the same lah, your view as compared to mine. You will have more or less the same thing here, but you gotta see the group C je lah. So in the web conferencing part, so you're gonna see the group C juga, and you're gonna usually use this part kan, nak log in to the class so that the attendance will be recorded kat sini . So just make sure, but I will just transfer and ni je, I click ni je, dia akan automatically go to the attendance punya page. But anyway, there's a video link kat sini whereby you can watch videos of previous recorded sessions. So so far I have try to update as current as possible lah. So for today, not yet lah, we haven't finished, right? So I will share everything here. So last time I shared here. Tak sure lah ada orang tengok ke belum. So last time I shared it here, these recorded sessions. Okay, but this is agak complicated because you need to key in the password because this is directly from WebEx. Okay, but I think starting once I found out that one, I share everything here je lah. Easier kot. Right? So every sessions you can view the video here. Okay, either directly from here, nanti you, I don't know lah. You just play it here. I'm not sure you boleh. You can share. I'm not sure you can open in the browser. I think yeah, but you can click it here to watch on YouTube and then you can full screen and whatnot lah. Okay, so later on, once the video available, I will upload it here for today's session. So just click kat sini je lah for the videos, just to let you know that. All right. Okay, thanks. So if there's no other questions, we're gonna stop here for today. Right, so inshallah we will see again next week with topic number 3. Okay, still risk and return, yeah, but for the portfolio, you're gonna see similar terms. You're gonna see ER, you're gonna see variance and deviation, but like I said, we have the extension of correlation and covariance to that. Okay, and for this topic, I will not do any quiz, but for our, at the end of third topic nanti, there'll be our first quiz. So just check in your My Guru regularly, okay, for any assignments or quizzes. But for time being, there's none, yeah. But yeah, just to let you know upfront, next week you're gonna have your first quiz. Okay, so with that, I think I'll stop here. Thank you very much again. Inshallah, I'll see you guys next week.
Sir.
Thank you, Doctor.
You're welcome.
Doctor.
All right.
Doctor.
Okay.